And welcome to Recording Transactions in General Journal and Relating to Entries in QuickBooks Part 1. This is the 5th module in our Bookkeeping Basics course. My name is Kathy Groskirth and I am your facilitator for this module and for this course. Again, welcome. Now for an overview of today's lesson. In these last two modules, we will use the General Journal to enter the same transactions we use with our T accounts, along with how these transactions relate to transactions entered in a computerized bookkeeping program such as QuickBooks. In this particular module, we will work strictly with the balance sheet accounts, which are assets, liabilities, and owner's equity. On the next slide, we define what the General Journal is. Now for a definition of the General Journal. The General Journal is a chronological record of all financial transactions that are entered for a business. Think about a personal journal, a day-by-day personal record. Well, the General Journal is basically similar in that it is a day-by-day business record. When you record entries in a personal journal, you are journalizing. You are also journalizing when you enter transactions in a General Journal. On the next slide, we will discuss the steps to record the data in the General Journal. They are similar to the steps in recording the data in the T accounts that we did in the previous modules. And now we list the steps to record the data in the General Journal, which are similar to the steps used to record the data in the T accounts. Step 1 is to identify which accounts are affected. Step 2 is to identify the account types for each, either asset, liability, owner's equity, revenue, or expense, and note if they increase or decrease. Step 3 is to determine which accounts are debited, which accounts are credited, and the amounts for each. Step 4 is to journalize or record the transaction. The next 3 slides get into the discussion of the General Journal and how to fill out the General Journal forms. Please refer to the first page in your handout for this discussion. Here at right on the slide, as well as on the second page of your handout, is a sample page from our General Journal. We will use this form to complete the remaining transactions, as well as using a blank version of this page that you should have received in your materials. On the next 2 slides, we will discuss the rules for journalizing in the General Journal. So again, make sure you have page 1 handy as we go through this discussion. Before we get into our exercises, we need to go over the specific rules for journalizing in the General Journal. Be sure to refer to the sample form included in your student handout as we go over these rules, along with the first page in your handout so you can fill in any blanks. It is also important to remember not to use whiteout or erase when you make a simple mistake. Simply line through the error, initial, and make the correction. We're going to cover the first 3 rules on this slide and the last 3 rules on the next slide. The first rule is that you enter the page number where indicated. These must be consecutive. No missing pages. This is part of our effort to maintain tight internal controls over our financial records, which lessens the opportunity of theft and or fraud by following certain procedures such as keeping good records, numbering everything consecutively, separating recording duties from check writing duties, etc. Rule number 2. To record a transaction, enter the current year, which will be 20XX for our exercises, in the first date column on line 1. In the second date column on line 2, enter the transaction date in the format shown on your sample form. Rule number 3, in the description column on line 2, you're going to enter the account to be debited. Remember, debits are recorded before credits. In our example, which is transaction 1 from our T account exercise, recording a cash investment, we record the cash portion of the transaction first. You're going to write the word cash, flush with, and no indent from the left margin. Then in the debit column, enter the transaction amount, which is $20,000. No commas or dollar signs are needed, but remember to include the cents. even if the zero amount. The next slide, we will cover the last 3 rules. Here on this slide, we cover the last 3 rules for journalizing in the general journal using our sample form and using as our example transaction 1 from our T account exercise, recording a cash investment. Remember to have your sample form handy as well as the first page of your handout so that you can fill in any blanks. Rule number 4. On line 3 below the debit entry, you're going to enter the account to be credited, which is Sarah Jennings Capital. Indent the account name approximately 1/2 inch from the left margin. Then in the credit column, enter the transaction amount, which is $20,000. Again, remember to enter the cents, but leave out the commas and the dollar sign. Rule number 5. Underneath the credit entry on line 4, write a brief but detailed description of the transaction. This time indenting the description approximately 1 inch from the left margin. In the example, we wrote investment by owner as our description on the sample form. Rule number 6. Be sure to leave a blank line or space between journal entries. See how the second entry for the computer and printer purchase starts on line 6 while line 5 is blank. Now we're ready for our first transaction. And now it's time to discuss transaction 1, recording a cash investment. As you may recall from our previous exercise on T accounts, to establish the books for this new business, Bookkeeping Clean and Simple, our first transaction was to record Sarah Jennings withdrawing $20,000 from her personal savings on November 1st, 20XX, and depositing the monies into a new business account. The sample form that you have in your handout includes the journalizing of this transaction. To understand what we did, let's review the rules of analyzing transactions and apply these rules to the first sample general journal entry. Please also refer to your T account notes if you need to. Now we go into transaction 1, recording a cash investment and discussing the first 3 steps to record this transaction. By now, hopefully you've internalized the rules of debit and credit. If you need a refresher, remember to grab the first page of your T accounts exercises because those rules are contained on that first page of part 1 and on the first 2 pages of part 2. So have those handy if you think you'll need them. Now on to step 1. Which are the 2 counts affected? The 2 counts affected are cash and Sarah Jennings Capital. Step 2. What are the account types and do they increase or decrease? Cash is an asset type and it increases by $20,000. Sarah Jennings Capital is an owner's equity type account and it increases by $20,000 as well. Step 3. Which account is debited, which account is credited, and how much for each? Remember, if you debit one account, you have to credit the other. We will debit cash for $20,000. We will credit Sarah Jennings Capital for $20,000. And on the next slide, we discuss how to journalize this transaction. And now we discuss step 4, journalizing transaction 1. Please refer to your sample form as we go through each of these items. On line 2, enter cash flush with the left margin in the description column. Enter $20,000 in the debit column, including the cents and leaving out the commas and the dollar sign. On line 3, enter Sarah Jennings Capital, indented 1/2 inch from the left margin in the description column. Enter $20,000 in the credit column, including the cents and leaving out the commas and the dollar sign. On line 4, enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. Now on the next slide, we're going to relate this transaction to a QuickBooks entry. And here's where we relate transaction 1 to a QuickBooks entry. In a computerized bookkeeping program such as QuickBooks, all these steps are automated. Therefore, the transaction would be recorded as a straight deposit transaction in QuickBooks. It would look something like what is in your handout and on the screen here. I'm going to go through each of these sections so you'll understand what it is we're looking at here. Starting with the top left corner, you're going to see where it says Deposit To. You're going to see a drop down and you'll see the word Cash. Cash is set up in our QuickBooks file as a bank account. Next, you'll see the date, which is 11/1/2013. Obviously, we can't do 20XX type dates in the QuickBooks file. In the memo field, you'll see Investment by Owner. Also in the memo field, in the line item, you'll see Investment by Owner. Now going back over to the left-hand side, where you'll see the Received From column, you'll see Jennings, Sarah, whom we have set up in our file as a special owner type of a vendor. In the From Account column, you'll see Sarah Jennings Capital. We have this account set up as an owner's equity type in our QuickBooks file. And again, you'll see in the memo field where we have Investment by Owner, you'll see the check number, you'll see the payment method, which is check, you'll see the amount, which is $20,000. Now, once you save and close this transaction, you will actually be able to run a balance sheet showing that your accounting equation is in balance as you go, which we do on the next page and on the next slide. You'll see how the balance sheet looks after entering this first transaction. We continue our discussion of how we relate Transaction 1 to QuickBooks. As we stated in the previous slide, the beauty of using QuickBooks is you can run a balance sheet as you go to see if your accounting equation remains in balance. Here you can see the balance sheet after entering this first transaction. As you can see it right, our accounting equation is in balance. Our owner's equity equals our cash account, as you can see. We have no liabilities at this point, so they do not show up in our computerized statement. Hopefully you can see the parallels with our T accounts as well as our general journal exercises up to this point. If not, it should start making sense to you as we go through these next few exercises. Now on to Transaction 2. And now we're ready to discuss Transaction 2, recording a cash purchase of equipment. As you may recall from the T account exercises, on November 5th, 20XX, Bookkeeping Clean and Simple issues check number 1001 for $1,000 to purchase a desktop computer and laser printer from Micro Center. This transaction is also included on the sample form included in your handout, so please refer to it as we go through the next two slides where we discuss recording of this transaction. And now we discuss the journalizing of Transaction 2, recording a cash purchase of equipment. Step 1. What are the accounts affected? The accounts affected are computer and printer and cash. Step 2. What are the account types and do they increase or decrease? Computer and printer is an asset type and it increases by $1,000. Cash is also an asset type. It decreases by $1,000. Step 3. Which account is debited, which account is credited, and how much for each? Computer and printer will be debited for $1,000 and cash will be credited for $1,000. On the next slide, we discuss the journalizing of this transaction. And now we're ready to discuss Step 4 of journalizing Transaction 2. Since this general journal entry has already been included on your sample form, please refer to it as we go through these items and discuss them in detail. First, on line 6, we're going to enter computer and printer flush with the left margin in the description column, enter $1,000 in the debit column, including the cents and leaving out the commas and the dollar sign. Also be sure to include the date. Next, on line 7, we're going to enter cash indented 1/2 inch from the left margin in the description column, enter $1,000 in the credit column, including the cents and leaving out the commas and the dollar sign. On line 8 and on line 9 if needed, and we did that here because we needed to, we entered a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. And on the next slide, we're going to relate transaction 2 to a QuickBooks entry. And now we discuss relating transaction 2 to a QuickBooks entry. We will use the write check feature in QuickBooks to record this transaction. We're going to go through the screen capture so you can know what's going on here. Starting with the top left corner of the diagram, you're going to see where it says bank account. You'll also see a drop down, and right now we have cash chosen as our account. That's where the money is coming from. Going along that same line, you'll see where it says ending balance of $20,000. That is the amount in our bank account, in our cash account, before we actually capture this transaction. Below all of that, you'll see what looks like an actual check. You'll have a check number, you'll have the date, you'll have the pay to the order of, and we have Micro Center selected. We have set them up as a vendor in our QuickBooks file. Once you type in the amount, $1,000, the dollars field populates. You'll also see in the memo field, we have purchase of equipment, and you don't really need the extra detail because, again, everything is going to be captured in this transaction below this actual check. When you look at the bottom of the check, you'll see on the expenses tab, which we have shown, you see the account, which is the computer and printer account that we have set up in our QuickBooks file as an asset, the amount again, and then the memo again on the line item below. Once you save and close this, you can also run a balance sheet to see how your accounts remain in balance as you go, which we're going to do on the next slide. And here is how the balance sheet looks after this transaction is complete. Basically, our asset amount is still the same, $20,000. We have less cash now because we purchased a computer and printer for $1,000. So our cash balance is now $19,000. Also note on the balance sheet is that we have the assets separated out into current assets and fixed assets. Current assets are things like cash and accounts receivables that you can convert easily into cash if you need to liquidate. Fixed assets take a little bit longer. They're like buildings and equipment and things like that. At any rate, our assets still total $20,000. Now for our liabilities and owner's equity, we still show Sarah Jennings capital at $20,000. That has not changed. We have no liabilities at this point. So our total liabilities and owner's equity of $20,000 equal our total assets of $20,000. So everything remains in balance in accordance to our accounting equation. Now we're ready for transaction 3. And now it's time to tackle transaction 3, recording a credit purchase of equipment. As you may recall from your T-account exercises, on November 10th, 20XX, the business purchased a laptop computer from Office Depot on credit for $500 payable in 30 days. The next slide walks us through the actual journalizing or recording of this transaction. In your handout is discussed all 4 of the steps to record this transaction. Be sure to read through the handout and make sure you understand those steps before you move on to the next slide and record the transaction in your sample form handout. And now we're going to journalize transaction 3. Be sure to use the sample form in your handout when recording this transaction. Remember, we are going to skip line 10 and start on line 11. Remember to put the date, and then next you're going to enter laptop flush with the left margin in the description column, enter 500 in the debit column, including the 0 cents and leaving out the $sign. On line 12, you're going to enter accounts payable Office Depot, indented 1/2 inch from the left margin in the description column, enter 500 in the credit column, including the 0 cents and leaving out the dollar sign. On line 13 and on line 14, if you need to, enter a brief but detailed description of the transaction in the description column indented 1 inch from the left margin. On the next slide, we're going to relate this transaction to a QuickBooks entry. But before we do that, be sure to double check your work before you proceed any further and make sure you understand the process before we move on to the next slide. And now we relate transaction 3 to a QuickBooks entry. As you can see in the diagram, this transaction is recorded in QuickBooks as a credit card purchase. Here is how it appears, and we will discuss this diagram in detail shortly, but I wanted to bring up a couple of things. First, Sarah Jennings, instead of using a store credit as was done in our manual bookkeeping example, she used an Amex credit card. Regardless of whether you use an Amex credit card, a store credit card, or whatever type of credit card, the transaction is the same. It's recorded as a credit card purchase. Again, like I said, the only difference was that we would use a store credit card, Office Depot credit card account to record the purchase. Now let's talk about the diagram. Starting with the area on the top left, you'll see where it says credit card. You'll see a drop-down menu. We choose our Amex credit card. Again, if we had used the store credit Office Depot credit card, we would show that as well. Underneath that, you'll see 2 radio buttons. The radio button for purchase charge is usually the one already selected. The other one is if you're issued a refund or credit, that's where you would choose that one. But since this is a straight credit card purchase, we leave the radio button for the purchase charge selected as is. Underneath that, it looks like a credit card purchase charge slip. You'll see where it says purchasing from, you'll see another drop down where you will choose Office Depot. Office Depot is set up as a vendor in our QuickBooks records. Next, you'll record the date. You'll type in the amount, which will also appear in the Expenses tab below. You'll type in your memo, which is laptop purchase payable in 30 days. Again, you don't need to type a long memo because all of this other stuff is being handled in the background with the QuickBooks program. Going to the Expenses tab, you'll see the account is laptop, which we have set up as an asset in our program. And then you would just copy the memo from the top memo field down to the line item. Once you save and close this transaction, you're ready to run another balance sheet to make sure everything is still in balance, which we will do in the next slide. And now we run our balance sheet after entering transaction 3. As we add transactions to our QuickBooks file, we can view balance sheet changes in an instant and view updates on an ongoing basis. Here below, we discuss the items that appear on the balance sheet as of November 10th, 2013. First, our current assets, which is our cash account, is now $19,000. Our fixed assets, which is our computer and printer in our laptop, total $1,500. Our total assets, therefore, equal $20,500. We now have $500 in current liabilities. Our Amex credit card now has a balance we have to pay off in 30 days. So our total liabilities equal $500. Sarah Jennings still has an owner's stake of $20,000, which equals her initial investment, and that has not changed. Our total liabilities and owner's equity equals $20,500, which equal our assets. Everything remains in balance. Now let's move on to transaction 4. And now we're ready for transaction 4, payment of cash on account or paying a creditor. As you may recall from our T account exercises on November 30th, 20XX, we pay in full for our laptop purchase back in transaction 3. The next slide walks us through the actual journalizing or recording of this transaction. But before we go on to the next slide, make sure you have your sample form handy as well as your handout, which lists all 4 of the steps that we need to go through before we journalize or record this transaction. Pay particular attention to the first 3 steps. Make sure you understand those before you go on to step 4, the next slide. And now we're ready to journalize transaction 4. Have your sample form ready and make sure that you skip a line between your previous journal entry and the one you're getting ready to record. It's going to be either on line 15 or 16 depending on how long your description was for your previous journal entry. You're going to start off with putting in the date. And then you're going to enter accounts payable Office Depot flush with the left margin in the description column. Enter 500 in the debit column, including the 0 cents and leaving out the $sign. On line 16 or 17, depending on which one follows after the first one, enter cash indented 1/2 inch from the left margin in the description column. Enter 500 in the credit column, including the 0 cents and leaving out the $sign. On the line following that one, either 17 or 18, and on either line 18 or 19, if need extra space, enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. On the next slide, we relate transaction 4 to a QuickBooks entry, but make sure you double check your work and make sure you understand what you just did before you proceed any further. And now we're going to relate transaction 4 to a QuickBooks entry. This transaction is simply recorded as a straight transfer of funds in QuickBooks. As you can see by the diagram here, we put the date, we put the account that we're transferring funds from, which is cash, and then we put the account that we're transferring funds to, which is Amex credit card. We type in the amount, put in our memo on the memo line, and we save and close. Once we do that, we can run another balance sheet to show where everything is still in balance. The transaction is processed as a transfer because it's already linked to our vendor, Office Depot, via our original credit card purchase recorded in transaction 3. Now let's go on to the next slide so that we can see how our balance sheet stacks up with everything recorded through this date. Here you can see our balance sheet as of November 30th, 2013, after having recorded transaction 4. Now our balance sheet reflects that we have less cash, but liabilities are decreased to 0. So here's the breakdown. Cash now totals $18,500. Current assets also totals $18,500. Total fixed assets of $1,500 does not change. Total assets are still $20,000. Sarah Jennings' owner's equity has not changed. It stays the same at $20,000. As you can see here, our total liabilities plus owner's equity is also $20,000. With the liabilities wiped out, our capital account equals our assets, and everything remains in balance. Now let's go on to our next slide where we compare our manual balance sheet after transaction 4 with the balance sheet here. Here on this slide is our manual balance sheet, which you can compare with the QuickBooks generated balance sheet shown on the previous slide, and both of these are included in your handout as well. With the exception of the breakout of the fixed assets from the current assets in the QuickBooks generated report, you can see all the numbers here are the same and everything is in balance. This concludes this lesson. And in our final set of exercises, we will be adding the income statement accounts. Congratulations on completing Module 5 of our Bookkeeping Basics course, Recording Transactions in General Journal and Relating to Entries in QuickBooks Part 1. Our next module is Part 2 of the lesson that we just completed. Again, congratulations! You are almost done with the course.